during my presentation, and I'm looking forward for your comments and suggestions. So the title of today's presentation is Information Asymmetry, Financial Reporting Quality, Debt, Trading and Pricing of Private Debt Securities. And during today's presentation, I would like to talk about two of my papers which explore financial reporting quality and information asymmetry in syndicated loan market. So I would start with some presentation for some motivation for my work and to explain to you why I explore information asymmetry and financial reporting quality in a setting of syndicated loan market. So the role of information asymmetry in financial reporting quality has long been of interest for researchers in finance and accounting. However, most of the prior research has been done in a setting of public debt market. Accounting research, as Florian has already mentioned, explores financial reporting quality primarily in equity market, and the role of financial reporting quality in public and private debt markets remains relatively unexplored. So in my work, I'll try to extend this research and explore what is the role of information asymmetry and financial reporting quality in private debt market or in loan debt market. And I decided to explore this research question in a setting of syndicated loan market, and there are a number of reasons why I believe the syndicated loan market is very interesting empirical setting to explore information asymmetry and financial reporting quality. First of all, syndicated loan market is private debt market and has a range of private debt securities. So syndicated loans may be issued both for private and public companies, and syndicated loans may be highly leveraged securities and investment-grade securities. The second reason is that syndicated loan market provides us some unique information on trading of private debt securities. Loans are usually not traded, so the only market where you can observe trading of loans is syndicated loan market. And the last and probably the most important reason is that I expect financial reporting quality to be very important in this market. It has been known for a long time that the demand of debt holders has a very significant influence on financial reporting and on financial reporting quality. However, it has not been explored in debt markets. Therefore, I believe that syndicated loan market is a very successful empirical setting. Before I get to discuss my specific research questions, I would like to go over very briefly on syndicated loan market because it's the basic knowledge that we need to go over my empirical results. The syndicated loan market consists of two markets. One is primary loan market, where loans are syndicated, and the secondary loan market, where loans can be traded after the issuance on the primary loan market. And syndicated loan is loan issued by a group of lenders, so every syndicated loan has a big number of participants. And syndicated loan is usually structured and managed by the arranger of syndication, and arranger recruits loan participants and negotiates the loan agreement and also monitors the loan after the issuance on the primary loan market. And private loans are actually private debt securities, but they have two very interesting features of public debt securities. First of all, as I have mentioned, syndicated loans are traded. And the next point, that syndicated loans are also rated by rating agencies. So syndicated loans are rated by S&P and Moody's as public debt securities. And all syndicated loans are floating debt instruments. They are priced usually above LIBOR. Regarding the trading of syndicated loans, there are a couple of features of secondary loan trading which are very important. Trading is performed via assignment and without recourse. And without assignment, via assignment, it means that the buyer of the loan becomes official legal holder of the loan, and no recourse means that even in the case of default, the seller of the loan is not responsible for the loan performance. And sales are performed via big financial institutions that act as market makers in this market. And it's important to know that market makers in this market face significant information risk because they usually trade with informed investors. If we consider a range of syndication and syndicate participants, they usually have much better information than other market participants. A arranger may call the company, a arranger may ask for some additional information, and companies usually support monthly covenant reports to the syndicate participant, so information knowledge of insiders is very important in this market, and I will refer to this later when I get to my empirical test. And the main secondary loan market participants are banks and institutional investors. And institutional investors, the largest institutional investors in this market are prime funds, which are mutual funds who invest in syndicated loans and collateralized loan obligations. They are institutions that buy syndicated loans, restructure them, and sell them as bonds of different degrees of credit risk. And syndicated loan is probably one of the most rapidly growing markets, at least in US. Firms issue over $1 trillion of syndicated loans every year. And what is especially interesting, the trading of syndicated loan is growing very rapidly over the last 10 or 15 years. So the trading volume of syndicated loan market was in 91 was just $8 billion. And in 06, it was already almost $238 million, and this market is expected to grow significantly in the next 10 years as well. The data sources are very usual for this type of research today. They are DealScan database and Loan Trade database. Two databases are provided by Loan Pricing Corporation, and Loan Trade database supports information regarding trading of syndicated loan, and DealScan database provides information about loan issuance on the primary loan market. I would like to start with the first paper, which explores the role of information asymmetry and financial reporting quality and debt trading, and I would like to talk about my first research question. So my first research question is, what characteristics of loans and firms influence information environment of syndicated loans? And in this research question, I will explore some general attributes of information environment of the company, and I also will talk about some specific characteristics of the syndicated loan market. So what the variable that I use to characterize information asymmetry or information environment of the company are distinctions between public and private firms, availability of public credit rating, and regarding public credit rating, I use availability of company private credit rating or loan-specific credit rating, loan size, reputation of the arranger of syndication, identity of the lender, so if the lender is bank or institutional investor, distinction between distressed and par loans, and loss and profit firms. And as you see, some of these variables are generally related to information asymmetry, and some of them, as arranger reputation, are more specifically related to syndicated loan market. My second research question is probably more interesting, and my second research question addresses the role of information of financial reporting quality in the syndicated loan market. In this paper, I test a couple of characteristics of financial reporting quality, but I pay very close attention to the importance of timely loss recognition. And Florian did a very good job regarding the background of debt securities and how debt securities are different from equity securities. So hopefully I can save some time and go briefly over the background why timely loss recognition is important in the debt market. We have already seen that debt securities are much more sensitive to economic losses than to economic gain. The most of the distribution of the company's profits are irrelevant for debt holders if there are profits and not losses. Therefore, I expect that timely recognition of economic losses should be very important to debt holders. And what hasn't been mentioned yet is that timely loss recognition also triggers more timely violation of debt covenants based on financial reporting variables. Debt covenants are based on financial reporting, and if company recognizes losses in a timely manner, it allows lenders to more quickly employ their decision rights in case of economic losses. And this feature of timely loss recognition is very important in syndicated loan market because syndicated loans have very extensive and tight covenants. So if we compare private debt contract to public debt contract, we will see much more extensive covenants in the syndicated loan contract. So to summarize, debt holders have an asymmetric demand for timely loss recognition, and the next question to ask, why do I expect that this demand for timely loss recognition will be related to information environment of the company? And the main idea here is back to the discussion of the importance of informed traders in the syndicated loan market. So as I have mentioned, a range of syndication and syndicate participants have an access to private sources of information about company. So if we, for example, assume that company doesn't disclose losses in financial statements in a timely manner, insiders will have much better information about potential covenants violation than outsiders, because insiders can get private information and they can better evaluate company performance. So in this specific setup, I see that timely loss recognition may decrease information advantage of informed traders, and therefore timely loss recognition or the quality of financial reporting will be directly related to the trading cost on the secondary loan market. Very briefly about research design, I measured timely loss recognition by two models, Basu 97 and Ball and Shivakumar 05. I think many of you are familiar with these models. So the first one, Basu 97, relates stock returns to accounting earnings, and stock returns proxy for economic gains and losses. So the model tests whether financial statements recognize economic losses very quickly when we observe economic losses on the market. And timely loss recognition in this model is based on the coefficient on negative stock returns, which is the sum of beta 2 and beta 3. I will not go over the second model, but I just would like to mention that the results are very robust, and it doesn't matter which timely loss recognition measure I use in the empirical analysis, I see the robust result. To summarize my results, before I get to the tables, I find that bid-ask spread in the secondary loan market is positively related to loan and firm-specific characteristics associated with information environment. I find that loans of private firms, loans without an available credit rating, loans syndicated by less reputable arrangers, distressed loans, and loans of lost firms are traded at significantly higher spreads. Regarding timely loss recognition, I find that timely incorporation of economic losses in financial statements significantly reduces bid-ask spread, which means that timely loss recognition increases efficiency of trading of private debt securities. If we get to tables, this table summarizes the result for the whole sample of loans for public and private companies, and we see that all information asymmetry variables are very significant, both economically and statistically. Probably the more interesting table is the next one, when I concentrate on a sample of public firms for which I can incorporate timely loss recognition variable and other financial reporting variables in the analysis. So what I see, what I see and what is very important is that the timely loss recognition significantly decreases the bid-ask spread in a secondary loan trade. This result is very significant, and approximately 1 standard deviation increase in timely loss recognition measure decreases the bid-ask spread by on average 9% of the median bid-ask spread in this market. So this result is also statistically and economically significant, and this result is consistent across different measures of financial reporting quality. What is also interesting here is the coefficient on a income variable. So for firms which have losses, we observe higher bid-ask spreads or higher information costs, which are traded on a secondary loan market. So information environment of loss firms are more opaque than information environment of profit firms, and this result is also very interesting. Regarding other measures of financial reporting quality, I test abnormal accruals and earning volatility. Regarding abnormal accruals, I see that high abnormal accruals increase bid-ask spread in loan trading, and my interpretation of this analysis was that this is probably related to that covenant hypothesis. So managers try to implement some income increasing procedures to avoid or mitigate covenant violations, and these procedures or some general uncertainty about the company with binding covenants increase information asymmetry in the secondary loan market. And to verify this prediction, I also did some more detailed analysis of covenants of the loans in the highest decile of abnormal accruals. And what I find is that for loans in the highest decile of abnormal accruals, most of the covenants are violated, or they are just above the covenant threshold, which supports my prediction that this positive relation between bid-ask spread and accruals are related to covenant violations. I also find that earnings volatility is significantly related to bid-ask spread. And given that I found in my first paper that information in asymmetry, including the effect of financial reporting quality on information environment regarding the borrower, is very important for trading of debt securities, I was also thinking maybe it's important on the primary loan market when debt holders issue securities or structure securities. So the next research question was, let's check whether information asymmetry will influence loan contractual terms in the primary loan market and not only trading on the secondary loan market. And at this point, I would like to mention two additional advantages of the syndicated loan market as an empirical setting to test this question. First of all, because we have just covered bid-ask spread, I can use bid-ask spread as information asymmetry measure regarding the company, and all prior research relies on some equity measures of information asymmetry in that research. For example, past papers explored analyst ratings of financial reporting quality, equity analyst ratings, dispersion between analyst reports and equity holdings to proxy for information asymmetry in a debt market. And it's not clear how these equity measures of information asymmetry are successful in a setting of debt market, and especially in a setting of private debt market. And what is probably the most important advantage of the syndicated loan market is that it allows to differentiate between information asymmetry between borrower and lenders and information asymmetry between secondary market participants. If you remember, I have mentioned that loans can be traded on a secondary loan market, but not all of them are traded. So some loans are issued at the primary loan market, and they're held to maturity by original lenders. So in this case, when lenders don't plan to sell securities on the secondary loan market, they should not price potential adverse selection in the secondary loan market at the loan issuance. In this case, if you observe any relation between information asymmetry and loan pricing, it should be related to information asymmetry between the lender and the company. However, if lenders plan to sell securities in the secondary loan market, they will probably also account for liquidity in the secondary loan market to price loans or structure loan maturity. So what I do to verify which loans are going to be traded on the secondary loan market, there are two ways to predict it. The first way is to say most of the loans of institutional investors will be traded on the secondary loan market because institutional investors usually issue loans to trade them later. And the second way to identify traded loans is to predict or build a prediction model which loans will be traded. And I base this analysis on a number of variables, and I try to predict which loans are traded. So I consider efficiency of the post-sale lenders monitoring to predict loan sellability. So if lenders can officially monitor the loan, there's a high probability that loan will be traded. For example, I find that loans with higher number of financial covenants have higher probability to be traded because covenants allow more efficient monitoring for the buyer of the loan. I also look at the characteristic of loan information environment, such as reputation of the arranger and loan-specific credit ratings. What I find that if loan has a specific loan rating, so not only the company public rating, but rating specifically assigned to that security, sellability of this loan is much higher. So ratings allow loans to be more liquid on the secondary loan market. I also address some expected liquidity issues and credit risk. Most of the loans which are traded will be more risky securities, and I also distinguish between loan types, between loans issued by institutional investors and loans issued by banks. To summarize the second set of results, I do find that information asymmetry is important not only in trading debt securities on the secondary loan market, but also in pricing debt securities in the primary market. What I find that higher bid-ask spread on the borrower's traded loans leads to higher interest rate on loans subsequently issued to the same borrower. And I also find that higher bid-ask spread on the borrower's traded loans are negatively related to maturity of loans subsequently issued to the same firm. So for information opaque firms, borrowers prefer to issue short securities to encourage more frequent renegotiation with the borrower and more frequent refinancing of the debt. And what I also find that this information asymmetry effect on pricing will be related to both types of information asymmetry. Information asymmetry in the primary loan market where loans are originated, and expected information asymmetry in the secondary loan market where loans are traded. This first table summarizes the results of the pricing of debt securities on the primary loan market, and just from the coefficient on the bid-ask spread, we see that bid-ask spread on the borrower's prior loans is significantly and positively related to the pricing of subsequent loans issued to the company. This result is very economically significant. 1 standard deviation increase in a bid-ask spread leads to 25 basis point increase in bid-ask spread, and this result is comparable to the impact of leverage and profitability on the pricing of debt securities. The rest of the variables are very consistent with prediction relations, and some of them again are related to general pricing of debt securities. Some of them are more specifically related to the pricing of syndicated loans. And I also estimate, as I have mentioned, the probability of the loan or private debt security to be traded on the secondary loan market. And what I find that bigger loans and loans with longer maturity, loans which are issued with the purposes of LBO, MBO, or recapitalization are more frequently traded on the secondary loan market. I also find that loans issued by institutional investors and more risky loans are more frequently traded. And what is interesting, the higher the number of covenants in a loan contract, covenants based on financial statement variables, the more frequently loans are traded after origination. And I also find that the reputation of the arranger, reputation of the lead bank in a syndication increases the probability of a loan to be traded. So when I try to differentiate between the information effect on loan pricing between primary and secondary loan market information asymmetry, I incorporate a bid-ask spread measure and also interaction measure because between bid-ask spread and trade anticipation variable. And what I find positive coefficients on both bid-ask spread and on the interaction measures. So this result indicates that the impact of information asymmetry on pricing of debt securities has two sources. First of all, even if security is not anticipated to be traded on the secondary loan market, information asymmetry is still priced, and this is information asymmetry between banks or institutional investors and the company. However, if banks or institutional investors anticipate loan trade in the future, they will also price expected liquidity or expected adverse selection in the secondary loan market because they know that they will sell security in the future and they will face some liquidity cost when loan will be sold. And regarding maturity estimation, I find exactly opposite result. So the higher information asymmetry regarding the borrower, the shorter maturity is of the loans issued to the company, and this result is probably expected because short maturity gives lenders more negotiation right and they can more quickly renegotiate loan terms with the borrower if borrower doesn't perform as good as they expected. And in my paper, I perform a number of robustness tests related to estimation. There is a big concern that bid-ask spread is proxies not only for information asymmetry, but bid-ask spread proxies also for credit risk about the company, because I feel bad to say it, but the consensus in at least in academic literature is that debt ratings, they lag behind financial performance of the company, and therefore because they incorporate debt ratings to proxy for credit risk, maybe it's not a very good proxy, and part of the bid-ask spread, what it captures, bid-ask spread captures some sort of credit risk. I do a bunch of robustness tests, and all of them find that bid-ask spread proxies, maybe it also proxies for some sort of credit risk about the company, but the main result is related to information asymmetry. And I would like to go over one test that, one of the robustness tests I did in the paper, and this robustness test is related to negotiation between company and the banks. Usually maturity and interest rates may be defined at the same time. So one of the concerns related to my analysis that I investigate interest rate and maturity independently. However, they may be set up at the same time during the negotiation process between the bank and institutional investors and the company. So what I do in this test, I try to simultaneously estimate interest rate and maturity as a function of information asymmetry. And what I find that all results are robust, that bid-ask spread is positively related to interest rate and it's negatively related to maturity. And what is also interesting here, that this is the only time where we observe that maturity of debt securities is related to interest rate. So the coefficient on maturity is positive and significant when we control for simultaneity between interest rate and maturity. All other tests show that maturity is not significantly related to interest rate. So this type of analysis emphasizes that in all debt research, it's very important to control for simultaneity between different contractual terms of the loans or bonds, because they may be decided at the same time in the process of negotiation. And the main conclusions from the two papers, which are very related to each other, is that information asymmetry and financial reporting quality, or I see financial reporting quality as one of the aspects of information environment of the borrower, are significantly related to pricing and trading of debt securities. First of all, probably the most interesting finding is the timely incorporation of economic losses in financial reporting significantly decreases bid-ask spread and increases the efficiency of the secondary loan trade. And I also find that the higher bid-ask spread on the borrower's traded loans also lead to higher interest rates on the subsequent loans issued to the same company, and I find that syndicated lenders or debt holders, if we can say it in more general terms, they issue shorter security for more informationally opaque borrowers. And to finish, I would like to talk for a couple of minutes about the future research, or how I see the future research. So syndicated loan market represents more than $3.5 trillion of debt financing, and definitely over the last 10 or 15 years, syndicated loan market became one of the most important financial markets in U.S. and outside of United States. In U.S., it is definitely one, if not the most rapidly growing market. And while the development in Europe, Asia, and emerging markets wasn't as dramatic at the beginning, they catch up in the last few years. So for many European and Asian companies, syndicated financing became the primary source of financing starting in 2003. And how do I see this market related to future research? I think that the rapid growth of this market, or the rapid growth of both issuance of the loans and trading of the loans, makes this market very important for research, both for financial institutions which issue, trade, and invest in the securities, and for academic research which investigate this important, new and important market. And how I see at least a couple of directions of future research. First of all, my paper, prior research, including my papers, primarily look on interest rate and maturity to see how financial reporting quality influences debt securities. However, it hasn't been explored how financial reporting quality influences other contractual terms of the loan, such as tightness of debt covenants or existence of performance pricing measure, which is based on financial reporting variables. And the second type of research which I think is still missing is the relation between primary and secondary loan market. We don't know exact information channels between primary and secondary loan market. We don't know if the same institutional investors trade in both markets or invest in both markets. And the last point which I wanted to mention is the very rapid growth over the last few years of international syndicated loan markets. And we don't know at this point, at least there's no academic research about international syndicated loan market, and the research there is also interesting for both academic research and financial institutions, because probably there are a lot of profitable investments in international syndicated loan markets. And thanks a lot, and I'm looking forward to your questions. Yeah. I try to repeat your question to make sure that I understand it as well. So the question is, do some investors self-select, and because they can't get access to private information, they decide to trade just in securities or loan securities of public companies? Is it? Oh, okay. Now I realize the question, I'll repeat it. So there are some financial institutions which have an access to private information, but officially, if they have an access to private information, they can trade on the public side, because you can't use private information from the syndicated loan market as a private bank or private lender and use it for trading of secondary loan market. I think this question is really interesting. It's actually related to some paper I'm working on right now. We try to investigate what investors in these securities do if they have an access to private sources of information. And I know there are some concerns that they're not the Chinese wall that institutional investors try to establish between private information and public information are not very strong. And sometimes private information is being used in public markets, even if it's not consistent with regulations. But I don't know anything from my own research yet what type of institutional investors do know private information but choose not to use it, and which institutional investor just decide we don't want to get private information, we will just trade on the public side. Yeah.
When a loan is purchased and put into one of these CDO structures, then it's no longer traded itself, right? Just the
Right.
securities issued by the CDO. So what kind of loans are those that are being purchased and put into these things? They tend to be covenant light as opposed to loans that are traded actively.
I'll just repeat the question, though. The question is some of this loan, which is very popular in this market, CLOs buy loans, they restructure or securitize them and sell them in a package of that securities. And the question is what these loans, what type of loans are there? Are they covenant light securities, which are usually loans which don't have very tight covenant structure or extensive covenant structure or anything else? Then my answer to this question is just from my understanding and reading business literature, because unfortunately the data all of us have doesn't provide information regarding loans which are restructured as bonds. We don't have empirical information about CLOs. But as far as I know, most of the loans which go into the collateralized loan obligations and are being restructured are high-risky loans or leverage loans. I can't unfortunately say anything about the covenant structure, but I definitely know there are more risky securities go into restructuring. Yeah. It's a great question. I'll just repeat it. I observed that some loans are traded on a private secondary market, and the question is this probability to be traded or the trading itself related somehow to the trading of public debt securities or bonds? This is a very good question. I personally haven't explored this question, but I think yes, like if just thinking about the question without any empirical evidence, trading of debt securities increase probability of trading of syndicated loans simply because you have more information available for the market. And the only evidence that I can use from my papers to support it, I definitely see that public loans of public firms and big firms are more actively traded on the secondary loan market. And these are the usually firms which have also public debt securities. Yeah.
You have looked at bid-ask spreads and its impact on primary pricing in the primary market. Have you looked at the pricing impact on secondary market pricing? I would think that when you issue securities for the first time, the Netherlands problem is more severe than when you start trading for a while. So have you looked at the bid-ask spreads impact on secondary pricing?
I'll just repeat the question because I'm not sure I got it myself. So I explore bid-ask spread in a secondary loan market, and I explore information asymmetry in the primary loan market. And the prediction is that maybe information asymmetry is more important in the primary loan market when loan is just structured than in the secondary loan market. So actually what I do with the secondary loan market, I explore the determinants of the bid-ask spread in the secondary trading. All bid-ask spread that I have here, maybe I wasn't clear, are from secondary loan trading. So the bid-ask spread I explore in the to test information asymmetry in the primary loan market, a bid-ask spread forms the secondary loan market. So I'll rely on the first paper to say bid-ask spread in this market is primarily determined by information asymmetry. Therefore, I can take bid-ask spread as the measure of information asymmetry and relate it to the future securities issued to the same company to test the impact of information asymmetry. So in the first paper, I said, okay, yes, bid-ask spread is a good proxy for information asymmetry in this setup. In the second paper, I test if it has any relation for the loan contractual terms. And regarding your second point that information asymmetry may be bigger at the loan issuance than at the loan trading, I can't provide any evidence, but I doubt it's what happens, because in the primary loan market, the bank who issues loans has private access to your information. However, when loan goes from primary loan market to the secondary loan market, a bunch of uninformed investors come to trade the loan. So my prediction or my understanding is that information asymmetry problems may be even more severe in the secondary loan market than in the primary.
Time for one more question.
There was a question here. Yeah.
So you're really arguing that bid-ask spreads are related to variation in information asymmetry, but in lots of these microstructure models, bid-ask spreads are also related to volatility and fundamentals.
Right.
So it looks like a lot of your results can be driven by, bid-ask volatility goes up, bid-ask spreads go up, and say yield spreads also go up. So I wonder whether you've thought about that as an alternative.
Yeah, it's a very good question, and it's related. I don't show a couple of robustness tests because we didn't have time, but I refer to my robustness test now. I will repeat the question. The question is very important to my paper. Bid-ask spread is composed of two components. One is information asymmetry component, and one is a transitory component. And transitory component definitely go up with the volatility, and what I can find maybe my bid-ask spread measure is sort of related to volatility of the company or more to the credit risk. So I went even further and I said, right, because a transitory component of the bid-ask spread may be related to some market volatility, I may capture actually credit risk, which is very important in pricing of debt securities, because credit ratings that I use are not very timely, or maybe they are issued before loan was issued and they haven't been updated yet. So I do a bunch of robustness tests in the paper to show, no, this, even if I can't decompose between information asymmetry component and transitory component because I don't have enough data in this data set, I do believe that my result is driven by information asymmetry component. And I'll show you just 2 or 3 brief tests. The first test, I check if the impact of information asymmetry on loan pricing is a function of prior relationship with the lender. There's a big literature in finance about relationship lending, and this literature saying if lender knows better the company, information asymmetry will be priced to a lesser extent, because even if company is a pig, for relationship lender it doesn't matter as much. And when I incorporate some proxy for relationship lending, I do find that the information asymmetry is not priced as much as for loans which don't have relationship lending with relationship with the lender. And I don't think that this result, that information asymmetry is priced to a lesser extent in case there's some prior relationship with the lead arranger, may be explained by any sort of volatility of or credit risk. Whatever can explain here this negative coefficient on the interaction of bid-ask spread and prior relationship is just information effect or information asymmetry effect. If this is not as convincing, I also incorporate in the analysis some small sample, which is the sample of loans with specific loan ratings. So Moody's and S&P, especially Moody's, rate specific loan securities, and rating which I explain